Welcome to the 13th grade. My name's Elliot Schoner. Let's talk about what we need to do to build a credit score or a credit history that lenders absolutely love. Hey guys, welcome back to the 13th grade. My name's Elliot Schoner. If you are new to the channel or you've not seen me, I am a net worth, $10+ million, dabble in basically real estate, started from nothing, went to something in a very short period of time. I did that through a couple of steps, but mainly through the graces of a couple of really great, amazing mentors that completely changed the way that I saw or act or just kind of just approach money altogether. It is my firm belief that the difference between those that make it or that don't make it is your circle of influence and those that are around you. The true privilege is, I'll say, is who your parents are, but just who is your circle of influence. The way that my kids will see, act, and approach money is going to be completely different than an average individual that came from a working class family that is just simply not exposed to these things. If you want to build true generational wealth, you need a combination of the right mindset, credit, income, leverage, and then, of course, investing those things with the idea of taxes in mind. As a give back for free, I basically teach a financial literacy course called the 13th grade. This video is a section, one small sliver within that larger field. If you get value out of this building credit lenders will love, and you see value in this, just keep in mind that this is one small little sliver to about, I don't know, I mean, 60 or 70 other videos within a financial literacy course that you can go right now. Of course, we're on all the social media if you want to consume it there, but you can go to mondipity.com, where we're trying to develop a community of just like-minded individuals so that you can expand your circle of influence to keep you centered on the right path, but where you can go and consume the full course for free. And it's actually just a tremendous amount of extra content and so forth. So again, for those who have already are following along with us, I'm just doing a kind of a reintroduction because this video will be out in other places as a standalone video. It's kind of a teaser for a section within our course. So without further ado, let's get started. So up until this point, we have talked about a lot of, all the things, how what's in your credit report and how's it determined and how do creditors make money and lose money. And so that now that we really get kind of an idea of how the bank is looking at it, we know exactly what they're looking for to ensure that, they take out good risk and that they don't lose any money, ultimately that they make money. And being that we want to be a partner with them, we want to be a good partner to them, right? We want to make sure we are a good partner. This is no different, ladies and gentlemen, than if you are male or female, it doesn't really matter. When you're, I don't know, whatever, your 20s or teens or whatever it is, and you want to go attract that other opposite sex, or you want to attract a partner or whatever, what are you going to do? You're going to be like, oh, well, I know that that person or that particular potential person is going to want me to be this way or look a certain way or dress nice or have a good personality, or, whatever it is, right? This is what my potential partner mate's looking for. I want to make sure I'm the best person that I can possibly get to attract that particular person. It's the same with, let's say, with lending, folks. If we know that lenders are going to they're looking for this basically unicorn, this person that has, a mortgage for, several years, that has, different credit cards from different companies with really high credit limits that they maxed out. And then they paid it all the way down, and they have student loans and unsecured loans, and they're able to juggle all those types of things. And a person with really good income, with a good stable job. If we know they want this unicorn that's out there for very small sliver people have, what can we do? Well, we can work on ourselves to get us as close to that as possible. If you are in a situation where you're brand new, you have no credit. So maybe you're 16, 17, 18 years old. You're perfect because you're a clean slate and you can start fresh. This is really where we're governing this course to. And this lesson to is to someone that's just like, you know what, I'm 18, I'm graduating high school, I'm going to college. Like, what I got to do to make sure I'm set up for financial stability, for financial security, to build generational wealth, right? How do I do better than my parents? That's what this is for. However, if you're in your 40s or 50s, you can still do these things. You've already got some things that are out there. So it might be a case that you have to go like, well, let's go clean some of this stuff up and then let's build from there before. But either way, now you'll understand exactly the things and the moves that you need to make and how you can kind of just do these things naturally in your life. And then you'll wake up 5, 6, 7 years from now, you'll be in the 800s and so forth. Before we go into that, I just put up the disclosure. I'll let it sit up here 30 seconds, whatever. I want to make sure you realize that in the course, we are now going to start to get into some things that have action items. Up until this point, we've just been talking a lot about what your mindset is and like how do you generate revenue and why that matters and how you generate money matters and like what is it even in a credit report and how do lenders look at credit as far as an approval, like very things that aren't necessarily actionable. They're just like a bedrock of things that you need to know. However, we're now getting to things that are actionable. So things I'm going to say, if you want to do these things, or if you want to, or this is what I did in my stance. And if you may choose based on your situation to go and sort of do some of those things, all of them, half of them, whatever. But this time or the next slides or from here on out, it's all actionable items, right? These are the things that you need to be doing to actually create that generational wealth. And so for that reason, I just want to remind you that I am not your CPA, okay? I'm not your accountant, I'm not your attorney. I'm not telling you as we go through this, I'm explaining to you what I did to move from nothing to something in a very short period of time. I'm telling you what I did to create, a nest egg of, I think like 14 million, right now or whatever. And, tons of short-term all the rentals and all like how I got to where I'm. This is my journey that's in it. I'm not telling you to go do any of these things. This is what I did. This is the only recipe. This is what I'm going to tell my or teach my kids to do. Okay. These are the principles that the wealthy teach their kids to do. Okay. You can choose to decide and not decide to do any one of them. However, if you do those, I don't know your situation. I don't know your specific criteria. I'm not telling you to go get a credit card. I'm not selling you a credit card or a different product or any kind of financial product whatsoever. Okay. I don't know who you are. I'm talking into a camera right now. So before you start to make these moves, I highly encourage you to reach out to some of the professionals that are out there. There's CPAs, you can get an accountant, the attorneys. There's all kinds of different resources you can do to get additional resources, additional education. And in fact, even in this course, even though we're going to go over this for maybe the next hour or whatever, below amadavy.com, there's probably tons of supplemental stuff that we're going to add in there as additional things that you may want to consider. Products change, interest rates change, rewards change, things change all the time in the financial industry. So before you do any action, like I said, go seek out those professionals. This is for educational purposes only. I'm not telling you go do this and this is what's guaranteed. And I'm certainly not selling you any particular financial product or anything right now. Good. Hopefully that covers my disclosure and the attorneys are happy. So without further ado, what do the creditors like, right? And so we kind of talked about that. But they want to see that you've had balances before, and again, this is the unicorn, but you've had balances before that were similar, and you've paid them down. You want to see that you've done that over a long period of time, and they want to see that you have enough money to make that payment easily. So what they're looking for is your willingness or your ability to pay, if you remember from talking the last lesson. So they're looking for a good income that's coming in, and they want that income to be stable, right? So they want to see like 2+ years of employment. 5 years is definitely better. 15 is even better. 80 years is unheard of, but obviously better, right? The longer the credit history, stable income is important, but they want to see on that income what it's going to be used for. So they want to see a kind of a low debt load. If you have tons of debt, it's going to be really hard for you to get credit. So we don't go into it here. And I don't necessarily know if we go into it in any other area in the course. So I'll just say to you that jumping from job to job to job will affect your ability to get credit. Okay. And so you may be thinking, and this is the this is the reason why we actually made this course. You may be thinking to yourself, hey, I want to jump from, this position every 2 years. I'm gonna jump to a different position. I have a friend that does this. She works in like investment banking, and she's like goes to BlackRock and Chase. I don't know the companies, but all the big stock companies, right? And she jumps because every time she does, she gets a really big amount of like bonus, whatever. And so you'll read articles and people are like, oh, if you constantly keep jumping jobs or whatever, you can get increases each time. And you should never stay at a job and just work there for 15 years or whatever, which is fine. She's doing it. I know the money she makes is well into the seven figures, and she's not doing any of these types of things. She doesn't use credit. She's just killing it all the other side. That's not necessarily for the person that is, an accountant or a nurse or a whatever, right? And so what happens is or like even worse, like if you're in sales, for example, if you're in sales and you're like a car salesman and then you go do financial sales and then you sell furniture, whatever, and like you're constantly moving your job, you're going to look unstable. It's going to be hard for you to get credit. So while it could seem beneficial to actually jump from job to job, the part of the reason this course is I want you to step back and at the end of this, after we finish all these lessons, step back and go, okay, what is my goal going forward? And is it do I need to jump? I'm going to do that for a certain amount of years and then we get a certain amount of income, but then I'm going to be stable after that because after that stability, I'm going to need that to get income. Should I be stable in the beginning and then get the loans and things that I need, but then maybe I can jump after that? Do I not jump at all? Do I jump all the time? Do I be stable? The point of this course is for you to, unlike you'll hear anywhere else, is able to take a 30,000 foot view and go, okay, this is my journey. This is where I need to be. I want to be at a nest egg of, let's say, $40 million by that time at this age. And then you sort of reverse engineer and you say, okay, here are all the moves that I need to make to doing it. And you know how they all line up. And so you're like, I'm going to choose this job and I'm going to do this and I'm going to do that because this helps me do in this area. That helps me do in that area and whatever. And you're going to know all of that. And then once you go down and do that, and now you've picked in that course, then you can go in a deep dive in some of the individual subjects. But it's for you to understand the whole top of it. So what I'm saying to you is that if you decide to go jump from job to job to job to job to job, just realize that there's consequences. There could be benefit to do that, right? But if you jump around and all of a sudden you get a loan and now you get an 8% loan instead of a 5% loan, that 3% of the money you borrow, you might be getting it because you jumped for the job. And so is a little bit of an increase that you got worth paying an extra 3% or not even able to get the leverage because that leverage was going to allow you to do this, that, and the other, right? Um, Hopefully I'll put a pin in it. And if I don't, and I'll go back to it, you guys write to me because it's an important, like we should do some extra, like some layering in different stuff. And I know we do a little bit of that later in the course, but like how some of these things, these little decisions can seem like they're small and insignificant, but when you need the thing later on down the road that will allow you to, pay 0% taxes or do whatever, like very, very important. Like if you don't have that, it could be hundreds of thousands of dollars. So you're like, oh, I jumped jobs so I can make 3 grand extra a month, but now I can't make 100 grand over here because I did that, right? So all of that, again, the point is to look at all of that. So what are creditors like? They want you to have really great income for a long period of time. So, decent income for a long, stable job, at least 2 years, but really 5 years is really, really start to get in 10 years. Like, forget about it. It's awesome. They want to see that you've had loans before and that you've paid those down. If you paid other people, you're probably going to pay them. If you've been loyal to them, you're probably going to be loyal. Actually, jobs work like that too. If they see you jumping around, they probably think you're going to jump. They probably don't hire you, right? If you've been at a job for 10 years, they probably think you're going to invest. You're a good investment. So it works like that with everything. But they want you to see, good income, good stable job. They want to see that you had other loans, that you paid them down. And specifically, they like to see if you actually were juggling multiple things around. And then again, if you got approved from some decent banks and wasn't like some crummy lenders, that matters. Like getting approved from a subprime lender versus like a prime lender, like American Express, holds a different weight. And again, ultimately, they just want to make sure that you have enough money to easily make that payment. So you have the ability to pay. And then again, you have the willingness to pay, which is you've been making your payments on time. And again, if the longer you've done that, the more indication is that you're going to continue to keep doing that. So the lower risk you are, so the better interest rate. The shorter amount you've been doing that, the higher risk you're going to be and the higher interest rate that you're going to be. The larger loans that you've taken out, this ability to get larger loans in the future. The small, if you only take out smaller loans, you're probably only going to get approved for smaller loans plus a little bit. There are actually underwriting guidelines. If you go back to the previous lesson, that works out where banks will have and say, I will never give you, more than 50% more than your previous balance. So if you've already had a $10,000 balance, they will never approve you for more than 15,000. They would never approve you for 30 or 40 because you've just not taken out that risk and shown that you can handle it. Okay. So without that further ado, you probably get the idea of what you got to do, but let's just start. You're 18 years old. And actually before we get there, um, if you are watching this and you are a young person, I would say 16 is probably a pretty good age because that's when you can start driving around and you have the need where you're not next to necessarily mom and dad. Um, you should get a credit card in your parents' name with you being as an authorized user because that stuff will start to flow to your credit report. Okay. Which means that at 18, you'll already have a credit score. You'll have 2 years of history. So, what I'm going to do for my children is when they turn 16, I will go out and I'll get a credit card. I'll take one of my credit cards I already have that's, let's say, been around for 15 years, let's say, and then maybe the balance is $5,000, and I'll add them as an authorized user. And a lot of times you can add people's authorized user. I can actually even put spending limits on their particular account. So I can say, well, they're only allowed to spend this amount or only on these things. Or if they do spend, I get a notice of it. So you can really kind of dial that down. But if you're young and your parents have good credit and they make payments on time, okay, you could go to them and say, hey, can I be an authorized user on your account? And so what that means is they have the credit card, they make the payment, they're financially responsible for it. But you become an authorized user, and so you get some of that, cred, if you will. It's not like having your own card, but it gives you something to get started. And so now you start having on-time payment history reporting to your credit report at 16, 17, 18, well before you ever even, had a chance to get your own card at 18 years old. Super, super, super recommend. There's actually whole industries out there right now where people that have very long credit histories of, let's say, 20 years on a card, and maybe they have a $40,000 credit limit, they'll go out and they sell what's called selling trade lines or buying trade lines. They'll just put an authorized user onto an account. That person pays them maybe like 2 grand, and they get to be an authorized user in that account. They never get the card. They can never call in or do anything, but that $20,000 or $40,000 credit limit in a 20-year history shows up on their credit report, and that boosts their credit score. And then they use that to then go leverage and get other scores. So there's a whole industry. We're not going to get into it. There's plenty of like guru people out there that'll explain that to you, but there's a whole industry. The point is that just being an authorized user can help you out. It doesn't necessarily help you out in that you'll get an approval on a loan that needs to be manually underwritten, but it would for any automated approvals. Okay. And so I don't think we covered this in the last lesson. This probably makes sense to cover it. But when you go online, let's say you go to, whatever, bank.com, and you want to apply to bank, whatever credit union, and you go and you're like, I just want a credit card for $1,000. You put your social and whatever. Most of all of that, because it's just small little credit cards and stuff like that, is manually underwritten by a computer system. And it just is like credit score, income, but done, approved, automatically goes out. It's auto approval. Okay. Banks don't really look at it. It's a small amount, 500, $1,000, whatever. It's not a big deal. Those trade lines that people purchase and just being an authorized user, because you'll have a credit score and then you'll have the income, can actually get you those automatic approvals and pretty easily. And that works out pretty well. If though you're going to go and try to get $100,000 loan and they open it up and they're like, oh, you have really great credit, but it looks like you're just an authorized user, that's not going to fly. Like the person, the underwriter is going to look at it and be like, actually, you don't have the pay history. You've been basically, mooching off someone else's credit history or whatever. I see that they're not going to approve you. So those authorized user schemes that people do, again, I don't recommend you do that. Those schemes are like just to get people so they can get the automated approval, and then people kind of get their own cards, and then they can kind of establish their own credit history, and then they use that, right? So anyway, if you're 16, you go to your parents, get it to be an authorized user, you can start to build credit. Only thing I would say to you is that if your parents don't pay their credit on time, it can hurt you as well, right? And so if you're an authorized user on someone's card and they stop paying, well, you have all those non-payments on your name. So that could be a bad thing. So just make sure whoever you get to be an authorized user is someone you want to be tied to in that regard. And again, you can have them for a couple of years and then just get taken off. It's not a big deal. So if you're under the age 16, even if you're 18, 19, you can still get an authorized user from your parents. If you're 40 years old, you can get an authorized user from your parents or from someone else. It doesn't really matter. So you can use some of those benefits to boost up your score so that you can get through some of the automated underwriting that's out there. So the first thing, the first bit of credit that you'll get is actually going to be a credit card. So let's say you're 18 years old, you just graduated high school, you're going to go off to college. I still remember when I went to college, I went to University of Florida and like kind of walking to the game on Saturday to watch the Gators play or whatever. There's all these little booths and people try to sell you shirts and stuff like that. But there's always the guy that's there that's like, hey, you want to sign up for the, University of Florida themed, credit card through Capital One or whatever, whoever it was, and we'll give you a free t-shirt. And so usually, and when you get those, they're like, small little cards, they're like $500. It's just like kind of a starter card. But the bank is trying to start a relationship with someone that's potentially could be college educated, that could have pretty good income coming in, and they'd love to establish a relationship and get that relationship you tied to them as a brand. And so they put the logo, University of Florida logo on it, whatever. So you'll use that card, and now you're 4, 5, 6 years, you've graduated, you've already had that card for that period of time. They kind of got you in that as they increase credit limits, hopefully they want you to charge up, not pay it, and earn money off you. Anyway, they're trying to establish that relationship with you early on down the road. So the point is that usually your credit card is going to be the first really loan that you can get. Potentially you could get an auto loan. If you're 16 or 17, I don't know why you would have gotten your own auto loan. Like normally your parents would have done that. So usually it is going to be the credit card. Well, we'll just start there. So the first thing I would say to you is you got to obtain a credit card. So the first thing, and I said this to somebody, and this is when I first starting this course, and why I started this course is I kept having young people at a restaurant that we owned. Like, what should I do? And I was like, well, you got to get a credit card. You got to build your credit. You got to do these things, which is just basically what we're doing here. And they're like, oh, well, what card should I get? Okay, so it's a good point. Now let's talk about it. If you have not, um, gone back and watched the other video on what credit cards are, what companies are looking for, and the bucket system, and prime lenders, subprime lenders, and so forth, you might want to go back and watch that. But remember, we talked about in the last episode, when you're going to get a credit card, not all credit card companies are the same. There's a lot of things to consider. Okay. There's different companies. For the most part, there's Visa, MasterCard, Discover, and then American Express. I don't know why I have MasterCard on here, but Visa, Discover, whatever. MasterCard's out there. It's whatever. Visa, MasterCard, Discover, American Express. Okay. In general, I'm not talking about companies. I'm talking about the processors. Okay. That might be hard to just, I'm not going to go into that, but this is just the people that process the transactions when you go swipe your card, right? So when you get a Bank of America Visa card, Bank of America is providing the money. Visa is providing the ability to use that card, the transaction. So you're not applying to Visa, technically you're applying to Bank of America for that card, in a way. So, however, that said, Discover, Visa, and American Express, they all have kind of different guidelines. What I'll say to you is that normally, like, you're going to get a MasterCard Visa when you're very young. Then you can kind of move to like a Discover card. And then after you've done that for several years, can you get your first American Express? Okay. American Express is like the pinnacle of that. Within the American Express brand, then there's like American Express charge cards. There's American Express where you have to actually pay the balance back every single month. Then there's the American Express credit cards where you don't have to pay the balance off. And then there's tiers. Like you've probably, if you're watching this, you probably know there's like, you've heard like, oh, there's a black card or a platinum card or whatever. There's actually cards right now made out of like 24 karat gold. Pretty cool. So there's different cards that are out there. American Express is usually the pinnacle of it, which is why when lenders see you have an American Express card, they're like, oh, well, American Express approved them. We'll approve them too. So for the most part, you're gonna choose one of those brands, and we'll say to you is you're probably gonna go with like a MasterCard or a Visa card. Okay. What I'll say to you when you're looking for a card, especially early on, when you probably aren't going to be charging a whole lot, and you're not going to be charging a whole lot because your credit limit's not going to be a lot. Your first credit card's probably going to be 500 bucks, 1,000 bucks, like somewhere in that range, maybe two. It's not going to be a huge balance because it's the first time, it's the first thing that's in your credit report. Like I'm talking about, like you have nothing that's happening on. Okay. And so for that, I would choose one with zero fees because one, why do you want to pay a fee? But there is reasons to pay fees because of the benefits. We'll get to that in a second. But in general, you're not going to have enough charges that are happening to build enough rewards to get enough benefit to justify any fees. So look for a no fee, no annual fee credit card. Now, no annual fee credit cards generally mean you're going to pay at like a higher interest rate, or the terms are different and so forth or whatever, which is fine because we're never going to pay interest. Again, so just find a card, Mastercard, Visa card. There's lots of, if you just go to Google or whatever, actually you can go to our website, manipity.com, but you can go there and be like, I need a card for like a student, student starter card or whatever. And there's different cards that are on there. There are credit cards out there called secured cards. So this is going to be in our lending section, but if you remember, there's secured debt and unsecured debt, right? So unsecured debt means that it's just approved based on your income and your credit, like your promise to pay. Secured debt is based on like the asset. So like when I buy a house, it's secured by the property. When I buy a car, it's secured by the car. If I don't pay the car note, they come take the car. If I don't pay the house, they come take the house, right? There are things called secured credit cards. Like if you can't get an unsecured card, you could use a secured card, but the idea there is like you mail them 500 bucks, or you put 500 bucks in an account, and the credit card company gives you a credit limit of 500 bucks. Now, you might be thinking to yourself, like, why would I want to do that? Like, I'm going to pay 500, but you're only going to give me 500. Well, the idea there is that you're establishing a relationship with the bank to show that you can manage a credit limit and pay it off. So you take 500 bucks, let's say you put it into a savings account, in an account with that bank, right? They give you a $500 credit limit. If you don't pay the card, they're just going to take the money out of the account, right? That's the secured part. However, the idea is that you're going to charge 300 bucks and then you're going to pay it off. Not with the 500 that's in the savings. That's going to stay there. You're going to pay it off and you're going to charge it and pay it off. And you're going to charge it and pay it off. And you're going to charge it and pay it off. And if you do that for a certain period of time, let's call it 6 months, a year or whatever, the bank then goes like, oh, look, you can manage charging and paying off and charging and paying off. I'm establishing that credit history. I'm willing to then go give you a real credit card, right? And so you can start with a secured card and then move to an unsecured card. What we're looking for, folks, is an unsecured card. Okay. So if you can't do that, if you did apply, if you're looking around, you're not having success, start with a secured card, do that for 6 months to 12 months. If you have bad credit right now, you've got some few things you need to reestablish. Secured card is probably going to where you need to go. If you're looking for that, again, you can go to the website, medipity.com, or you can just go and Google search and search out there. There's plenty of places that will kind of lead you in the right direction. Just make sure you're applying to the right bank that approves your particular credit history and so forth, as we talked about in the previous call. So no fees. Should I get one with no fees? Yes, that is correct. You should not get one with any fees. Maybe fees if rewards. So this is what this is specifically talking to people right now that are maybe late 20s, early 30s. Maybe you've gotten a couple of credit cards already. Okay. And you have, so you kind of established that already. And you're like, well, how do I build credit? I've already done that part or whatever. Well, you might want to go get a credit card. And if you're charging a significant amount, I would say, $1,000 to $2,000 a month, right? You have to do this your own calculation on this, but you may want to get fees if there's great rewards that you can benefit from. So I want to I'm gonna watch it. We're gonna watch a video real quick. Hopefully it'll play. If not, then we won't watch a video. But the point is like I want to show I want to show what the industry is kind of saying about rewards, because there's a huge hot debate. I'll give you my rendition of it, but it might be worth paying a fee if you get like say $1,000 worth of rewards every single month, every single year, and your annual fee is $95. Like, yeah, why wouldn't you do that, right? And so in some cases, it makes sense to take with fees, but that would only be with if you were charging, a few $1,000s a month so that you could get enough of points or enough rewards to justify the annual fee. So hopefully that makes sense. But without further ado, let's watch this video real quick. And this is from Dave Ramsey. So this is not Dave Ramsey himself. I believe like this is a family member, a son or whatever, George Carmel. So all credits to him. It's just something he posted on his YouTube. So the video I want to watch here is from like the Dave Ramsey Club or whatever. And you remember we talked about like there's two different methods, right? There's like I call it the Dave Ramsey method, the Grant Cardone method of building wealth. The Dave Ramsey method would be never having credit card debt, paying down your house as quickly as possible, like no leverage whatsoever. And then there's a Grant Cardone method, and that is about like, yeah, you're having lots of leverage and all that kind of stuff, carrying massive amounts of debt, but having tremendous amount of cash flow. We are going to gear this more towards the cash flow method because I think it is the only way that you can move from nothing to something in a very short period of time and create the massive generational wealth. That's what we're shooting for in this course. If you want to do the other one, you can absolutely do the other one, but that's more about just getting to a stability standpoint and living the kind of a decent life, and downsizing later down in life and so forth. But so this group comes from those guys that don't like to do anything with credit cards. So before I get into credit cards and credit card rewards for a moment, I want you to listen to the other side of it because I think they can say it a little bit better.
However, I always pay the full statement balance every month, never carry a balance. It's always on auto pay. Never paid anything in interest or fees. By doing this, I take advantage of the sign-up bonuses and cash back rewards without going out of my way to buy things I wasn't already planning on buying. It's also given me a huge boost on my credit score. And I feel like I might be beating the system. I'm completely open to constructive criticism.
Okay.
If there is an argument against it, absolutely.
Well, let's play it out with your own situation.
Yeah, let's just play it out.
I truly want to help you, as fun as it is to have a friendly debate.
Yeah.
What do you make a year?
I don't know how much it adds up to in a year, but I make it. I bring home $5,300 a month.
That's your take-home pay after taxes?
Yes.
You bring home $63,000 a year. How much of that have you put away for investing in savings?
My living expenses, including just anything I need, all the essentials, I only pay like $1,500 a month. Everything else just goes into investments.
So you're investing like 60% of your check into investments every month.
So $3,800 goes to investments. What investment is that and what account?
So I have ETFs on like Charles Schwab. I also have like a 401k.
The wealth that you've accumulated has nothing to do with credit cards, Kyle. It has everything to do with your ability to flex your savings muscle and put away 60% of your income on live on less than you make.
Yeah.
So you're much more aligned to us than you think. And here's the thing, even if you pay it off perfectly, every study shows that you spend more when you use a credit card. 48% of people statistically pay off their card every month. So you're in the 48%. But here's the deal. Researchers from MIT did a study in 2021. They used fMRI technology and they looked at brain activity when people were swiping that card. And so this is what's wild. We've already proven that credit cards reduce the pain of payment, but this study added another layer. Not only do credit cards release the brakes on spending, they also cause our brain to step on the gas, accelerating the spending. And so when it hurts less, it costs more. And I'm telling you, when you spend your own money, even though you tell me you treat it just like cash or a debit card, I'm telling you, it causes more pain than using someone else's money and paying it back later. If you're making $60K take home, you might be getting $1,000 in rewards.
Yeah.
That doesn't add up to much when it comes to wealth building.
Well, I mainly, I'll farm the sign-up bonuses. So like if I plan on buying a computer.
Okay, so we're going to stop there, just to kind of give you an idea. So I want you to hear the kind of the extreme part of this. So if you could, they do this show all this time where people call in, they're like, here's my income, this is my debt, what should I do, and whatever. And oftentimes they will get these people that will come in and they'll say, listen, like I'm doing credit card rewards and I'm going, and basically what he's saying is like, I have a credit card, I'm charging on it. And, over the course of the next year, the rewards that I get, the dollar amount of those rewards is $1,000. Okay. And so what the host is saying, basically, George, to his credit, which is true, I guess, based on the studies or whatever, right? Is like when if you go to the store, if you're going to go buy something, when you take out $100 bill and you hand it to somebody versus you taking a credit card, like you'll spend more because you're just kind of swiping a card and you're not physically touching the $300 or $100 or whatever it is that you're spending on. When you have to physically hand over money, psychologically, it just seems like more. Like imagine if you would go buy a card and you had to bring in like $40,000 in cash. Like it would just seem like a lot of money. With a card, you just, done, right? So the point is, what he's saying is like, even for the people that are saying they're doing really good with rewards, they're actually spending more. And so this is the geek out part of that. It really frustrates me on just the financial literacy people in general and whatever, is we get so dialed into like tweaking the smallest little tiny thing or whatever. Like if you want to be crazy and geek out about like, oh, well, I spent, if I went to a restaurant, I wouldn't have got an appetizer if I bought cash, but I use a card, so then I got an appetizer, so I spent extra $8 there. And if I do that, of course, a month, I spend more. I mean, he's basically saying, he's like, yeah, you make $1,000 in reward, but you spent more money. So you really didn't, because you probably spent $1,000 more a year. And he goes on to literally saying, is like credit cards try to do different things just to get you to think that you're winning, even though you're not winning. Let me be clear with you. To be successful, I'm going to just kill this. To be successful in wealth building, okay, which is why we started the course painstakingly, probably for some of you, with this right here, with your mindset, okay? We started it with your mindset because your mind has to be strong and crystal clear on what you're doing and why you're doing it. Okay. You have to surround yourself with like-minded people. You have to make good decisions. Okay. The whole point of this course is for you to understand how all the things go together so that you can come back and make really great decisions. If you don't have, I'll make an argument, like if you don't have enough mental capacity or brain power, willpower, whatever you want to say, to understand that when you go swipe a card, you should only be spending whatever it is you should be spending, like whatever you're budgeting, you should be spending, and don't overspend just because it's on a card, just because it's on a credit card. Don't go, well, I really can't afford the $200 pair of shoes, but I'll just buy the $250 pair of shoes because hopefully I'll have the $250. Like, you have to understand intimately where you are, your finances, your income, or whatever. Like, do not, while the studies show all of this, right? The studies also show it's not with the or are of 99% of the people that have no financial literacy and just kind of just move through life and just swipe cards and just kind of do whatever. It also is correlation, causation. People that only use cash versus people use credit cards. The people that are probably using cash and that are that crazy because they only use credit cards are probably so dialed in at living frugal, they probably don't spend more, or they don't have any money whatsoever and they have terrible credit. So then they probably aren't spending it because they don't have any in it to begin with. So again, causation, correlation, right? The point is, ladies and gentlemen, I don't use this you should be able to take a card and go spend cash or spend with a card and still be doing the exact same things, the exact same type of purchases. Okay. It shouldn't affect you one way or another. They will say, well, it's a waste of your time to go in and try to figure out the reward points. And then you got to switch cards and you got to do all of this. Like, why not just focus on just go be happy, whatever. Keep in mind that when you're listening to gurus, that they are ultimately trying to sell. These guys sell a lot of books, they sell a lot of courses, whatever. They're trying to sell you a certain lifestyle that you will follow. Okay. There's a lot of different ways to do it. That's just their niche. That's just the way they do it. Don't just listen to one person. Listen to Dave Ramsey. Listen to Grant Cardone. Read. There's several other books that we're going to have, through the website. Look at all of those things. Then make a decision on the path you want to go. If you decide you want to do it, you only want to do cash, get it, but you're not going to be able to use a leverage. So we're talking to people that are saying, I have to go and use credit cards because I want to build a credit score, because I want to use leverage in the future, because I want to maximize my income and my cash flow. The point is that just keep in mind when you're watching people, some people say you should do this. Some people say you should do that. Just do what's best for you. This course, in order to be successful, we're going to have to use credit. You don't have to use credit and do the rewards games. So you don't have to do You don't have to go in and, get an annual fee because of rewards, like I just covered it. Go get your first credit card, choose a Visa, a MasterCard, do something with no fees. Only charge what you would normally charge anyway. And like I said, we're going to pay that off each week, right? If you want to go and do the rewards game, I do the rewards game every single year. And it means I just booked a trip to Costa Rica for 7 people, all of points. All of points. Tens of thousands of dollars, because in my businesses, I can use credit cards to pay for many things. And those points, when you're charging $10,000, $20,000 a month, those points add up really, really, really big time. Okay. I don't charge anymore. I don't spend anymore because I have the mindset that I know that if I spend more, that's less money that I'm going to then be able to go do for other things, whether it be other investments, other businesses, or whatever. You have to be strong enough to be able to have the control of your finances. If you don't, you're never going to be successful. If you want to do the rewards games, when you're going out there and you're watching people, just keep in mind, you can do the rewards game successful. Okay. Will be the unicorn, as he says in this video. If we watch further, like, you would be the unicorn, you would be the people that the credit card companies hate because you're literally making money off of them each month because you're paying them 0 interest, you're paying them a little annual fee, and they're giving you thousands of dollars. You've never fallen into the trap. You will drive them crazy. You are the unicorn, but that's the point. That's what I'm making you. That's what we're doing here. I'm making you the 1%. Okay. If you're going to be a 99% or 99% or mine, you're going to get a credit card and you're going to charge it up and you're not going to pay it off. You're going to pay interest. Don't go get a credit card. And you don't need to build credit because you're never going to be able to get leverage and you're never going to be able to do the things anyway because you don't have the mindset. You're not strong enough. You have to change your spending habits, the earn and consume lifestyle. You have to change or be willing to be uncomfortable now so you can be comfortable later. You have to be able to change and say, I'm not going to go do those things like everyone else is and get myself in a bad situation, because if I do that, I'm never going to be able to do this and this and this. And I have to do this and this and this to be worth $40 million at the end of retirement. Okay. So again, the course is about showing you the entire process so that you can understand that when you go to Chipotle and you go, oh, I just have my credit card, so I'll get guacamole too, that you understand that that extra $2 or that extra $5 cup of coffee, as we talked about the Starbucks scenario, does add up to millions of dollars later down the road. So he's right in overspending, but we're not applying that to us because we are going to be the 1%. So keep that in mind. Choose a credit card. You're going to do that. You're going to do like probably a Visa or something like that. You're probably going to do a student Visa account. If you're established, to get back to it, if you're established, and so you have already some balances and things like that, and you kind of want to know the next steps, you can get larger accounts. You're going for larger balances. Go for a Discover. Maybe you're ready to go for American Express. Go for a large amount. If you want to get something with an annual fee because you like the rewards, perfectly okay. Just make sure that you're charging enough to get the benefit. So you should say to yourself, what do I think I'm going to charge each month? Let's say it's $1,000. Then you know you're going to get 1,000 points. So you have 12,000 points at the end of the year. And when you have the 12,000 points, the 12,000 points generally equals about $1,200, but every card is different. And so with the $1,200, is it worth the annual fee? And then what would you spend that on? Just do the math to make sure. If you get a credit card with a $95 annual fee, but you only put like $100 on it a month and you're at $1,200 a year, it probably is not going to add up. It probably is not going to make any sense. I want to give you a prime example of a card that is amazing. This is a card I use, and this is what I do. So again, not a recommendation for anyone else. This is what I do, and I'm now 40 and I've been in my credit history is an 800, right? I spend the American Express Platinum has a $700 annual fee. The interest rate is 22 to 29% APR. Doesn't matter. I never pay it. The rewards that I get, okay, $200 hotel credit, $200 airline fee credit, $155 for Walmart Plus credit, $240 digital entertainment credit, $100 I shop at Saks, $2 in Uber Eats cash, and $189 for Clear Plus credit. And there should be another one on there, but it doesn't show. But what's the other one? TSA pre-check. So if I'll let you guys add all those up, but it's more than $700. So when you get the card, you pay $700, right? And so what I've said to myself is like, of the $700, would I do all of these things anyway? And so if I'm going to be doing these things anyway, and I get credits for those, well, then it equals. So just simple stuff. On a routine basis, I go to airlines and hotels. We try to travel like somewhere between 5 to 10 countries a year. And so when I travel for an airline credit, if I go get a ticket or I'm on a plane and I try to get Wi-Fi or I get some drinks or whatever it is, I can baggage fees. I can basically apply $200. So if I'm paying, was it $700 for the fee? All of a sudden now I have $500 that I'm paying for it because I'm going on the trip anyway. So when I go when the charge comes up, I just tell American Express take $200 off, and they do. I go to hotels and I get a $200 credit. Okay. The cool thing is when I charge things with American Express at a hotel, you get an automatic upgrade. This is kind of the other benefits that are in the asterisk and the thing. I get a room upgrade and generally $100 credit for that particular room to be used in the hotel somewhere. To continue in a second, but I also get a $200 credit. So I go and I book a room. Let's say the room was $1,000 for 5 nights, $200, whatever. It's $1,000, right? So I spent $1,000. They're going to take $200 off the room charge, right? Just off the statement. So I have $800. But when I went to that hotel, if they have a better room, so if I just booked like a standard suite, sometimes they'll book you up to like the penthouse, and this has actually happened to me. So I booked a room that was like $500 in Salt Lake City, Utah, and they booked me up to basically an entire house. Penthouse, what had jacuzzi, like it was crazy, right? Probably $3,000 a night. It's a part of American Express benefit, and they have to bump you if they have a room. It's just part of their policy, right? So you get a bump up, which, okay, that's a benefit, but you wouldn't have spent that, so maybe you're not earning anything, but they get the $200. So I'm getting the $200 airline credit, $200 hotel credit. When I'm in there, so when I was in Japan, I was at American Express. We went to Tokyo, Osaka, and Kyoto, in those 3 places. In each place, we hotel. So 3 different hotels. Each hotel, I got a $100 credit, and you could use that either for the mini bar, or you could use that for like spa services or whatever you wanted to in the hotel. I chose the mini bar, and so it was just funny, but I had these little mini bottles of Yamazaki, which is my favorite whiskey. And so they have it in the mini bottles, which it's hard to even find here in the States, but they actually have it in mini bottles all everywhere because it's their staple. It's a Japanese whiskey. And so everywhere I went to the hotel, and I just basically cleared out the Yamazaki, which I think they sold for like $4 or $5 for just a little thing. Here in the States, it's like $30 a glass. It's crazy, the difference. But I just like literally filled up my went to the first day, cleared it out. They came, restocked it, cleared it out, restock it. Like I drank Yamazaki the entire trip for free, based on American Express. So I add that as a benefit, although that's not a direct cash benefit. Shopping at Saks, so they'll give you a $50 credit every 6 months. So January through June, and then July through August, $50 credit. Saks has a couple things that I like that I buy. I mean, it's a department store, right? And so I'll go there and I just buy something for $50 and they just credit me in my account. So between the airline, the hotel, and the Saks, I'm already at $500. When we travel, you get Uber cash. So when we travel, we always take Ubers everywhere. I also will order through Uber and just even pick up here locally. I don't actually usually get food delivered because I'm too cheap for that. But I'll use $200 in Uber cash all day long. So that's $700. So just those benefits themselves, I'm already making back my annual fee. I'm going to travel. I'm going to do Uber, and I'm going to buy some stuff off Saks. Okay. And so I'm already doing that. I'm not spending more. I'm not doing anything. I'm already doing those particular things. So in addition to that, then I get $189 for Clear Plus. So Clear Check. So when I do travel, I can use Clear. I also have TSA PreCheck. Both of those I get through that particular card. So I have both. So I can do TSA PreCheck and that Clear, which is kind of amazing. In addition to that, I signed up through Walmart Plus. I don't buy things through Walmart. Walmart Plus, I believe, is like you can have stuff delivered to your house. I don't want my groceries delivered. I don't want people touching my apples and stuff like that. Actually, we grow it, most of our stuff. But either way, I don't buy groceries. But if you go through Walmart Plus, you can actually sign up for Peacock or Paramount. One of those two comes with Walmart Plus. So I sign up for Walmart Plus and I add on that digital subscription service, which pays for that. So they pay for that. Then in addition to that, I go to the 240 digital entertainment credit. That is usually to a couple of companies that they have. So you can sign up for ESPN. They've had Netflix for a while. They've had Hulu, Disney Plus for a while. And so basically what happens is you get $20 a month. So you go sign up for a service and they credit your account. Out of all of those things, I got my annual fee back. Okay. Now, I want to add that up to you. Hotel credit, airline fee, Saks 500, 700 Uber Cash, 155 Walmart, that's 855. Clear Check and TSA, let's just call it $200 a piece, 1,200. Then the digital credit, you're at like 1,500. So why would American Express do that? Well, if you remember the previous slide, the 22 to 28% interest rate, well, most people, right, the 99% will charge up their card and then they pay balances. Man, after paying a couple of interest rate bills on that or interest payments on that balance, you lost your benefit, right? And so, but in addition to this, when I charge on my American Express, I get like 1% here or 5 points. Like there's different points categories. I won't get into them now. But every time I charge, I actually get points. So at the end of the year, let's say I'm charging $20,000 a month, that's $240,000 points that I get, right? And if I'm charging on those things on certain categories, sometimes I can get more than that. So at the end of the year, I might have 200, 300,000 in points. That $300,000 of points they'll give me, and then I use that to book the airlines, the trips, or the tickets, or whatever. So that might be like another, $3,000 or so on top of that. Okay. Now, here's the thing, and guys, we're going to talk about a lot. The rich continue to get richer. Okay. If you do the correct things and you get good credit, you do all the right, and then you get American Express, and you've chosen a business, and that business allows you to go charge a bunch of things, right? Like we're in real estate, so we're buying stuff from Home Depot and like whatever. So we're charging all this stuff on credit cards. One of the benefits by having good credit and by choosing a kind of a good career, one of the benefits is that I then get to travel, usually to other overseas for free because I do it all with points, right? So you gotta have to understand that. In addition to that, waived fees. Now, how do you do that? Well, here's what happens. American Express, one of the ways that banks make money, okay, not banks like Bank of America, but like American Express, Visa, whatever. When you go and I take my card and I swipe it for something, the company that I'm buying it for doesn't get that full amount of money. So if I go buy a $5 Big Mac, right, and I swipe my card, they don't get McDonald's doesn't get $5. They get like $4 and I don't know, 90 cents or whatever, like 1% to 3%, like somewhere in that range, depending on the fee, depending on the card or whatever, actually gets processed. Like American Express makes money because when you swipe it, American Express charges McDonald's to transfer money from my bank account to them. Okay, there's an interchange fee. And so if I go to where rewards points come from, if I go to, let's say, American Express and I charge $100,000 a year in charges, they make 100,000 times their change fee, which might be, let's say it's 3%. They're making a pretty nice big amount of money just off of that. And so a credit card, if the credit card company is charging 3% to say McDonald's to allow them to use the card, they can give you 1% back, right? They're still making 2%, the difference. We're going to talk a lot about in this course about how the wealthy make money off the difference. between what they spend, what they get. It's the middle, right? That's how wealth is generated. That's what they don't teach you in school, right? So American Express goes to McDonald's like, hey, we're going to sign up. We want people to use our card. We're going to issue it to all these different people or whatever. But when they use the card, you're going to pay us 3%. And then they go back to the card issuers, remember, because they need people to use their card. American Express is competing with Discover and Visa. So they'll go to them and say, hey, we're going to give you all these rewards. You're going to charge $700 for it. And we're going to make you charge $700, but we're going to give you enough rewards to cancel it out. But the point is, we know you're going to use a card because you're going to use the card because you're paying $700 onto it. So you're paying a subscription service. Like you're paying to go to the gym, and now you're going to go to the gym because you're paying for it, right? So you're going to use that card even though the wash is wash, right? So I get all the airlines and all that. That's a wash. Then I go charge $10,000, $20,000 a month, right? Charging, whatever. They're getting interchange fees. They're going to give me back 1% rewards. They're going to keep the rest. That's how American Express makes their money. And so when they give me back all of that money to go book on a trip, the bank's not losing money because remember, they earn zero interest off of me because I paid my bills every single month, right? They're not making money off me. They're actually making money. They're making money from McDonald's, the place I go shop. The more volume that I do, the more money they make. So what I'll do is I'll call up, and I do this every year. And I call up American Express. I'm like, hey, I'm just looking at this. I just got dinged. I think American Express fees like now it's like $800 or something like that. Like, oh yeah, just look at this fee. It's it's $800 or $700, whatever it is. Like, it just seems too much for me. I don't know. It's just not really that much of a benefit. And then they'll be like, well, yeah, but you're getting all this other stuff. I'm like, yeah, but Chase Sapphire gives me that. I bank with them and whatever. I just do it. It's a process. Maybe we'll do a video on that someday. And usually what they'll say to me is, okay, well, you know what? You've been such a loyal customer. You've been with us for 15 years. I would hate to lose your business. Like we've always, we've been friends for 15 years. How about this? If you commit to continuously spending for the next 3 months, the way you've been, so if you charge $4,000 in the next 3 months, for example, we'll just go ahead and waive the fee, the annual fee. And so funny enough is I go in, I sign. So what I did is I signed up for a card to a $700 annual fee. I got all the benefits, the Claire Plus, the Ubers, all that kind of stuff. And because I was using so much and charging, spending so much, right? You could say because I was wealthy, it's not really that case, but because I had a business and I chose that, I paid zero, I don't even have to pay the annual fee. So I got all the benefits with zero fee and maybe a couple grand in rewards payments that are going back to me simply because I used a credit card. I don't think about it. I don't do anything. The only thing I do is every Friday I go and I pay the balance off. Okay. So you can do these really great things where you can get really great rewards. They're using credit card fees. What the bank wants you to do, to be fair, what the bank is expecting you to do is for them to go, hey, we're going to give you this, but we want you to charge it and you're going to charge it. And then you're not going to be able to make the payment. You're going to overspend, right? And then they're going to start charging that 20, 25% interest on it, and they're going to get all that money back. So not only they're giving you a little bit of rewards back. So we'll give you back a little bit of rewards, but we're going to charge you 25% of the money. Like you're losing it. We'll give you 1% back, but we're charging you 25%. That doesn't make any sense, right? Rewards only make sense if you have the discipline to charge it, pay it off, and charge it, pay it off, which is also why I never say we teach you do not charge and then pay it off when the statement comes. You charge for the week, and on Friday, you pay off the balance. You charge for the week, you pay off the balance. You charge for the week, you pay off the balance every single week. And that way you always know you're never going to overspend and you're never going to charge. So wealthy people keep getting wealthy. And so if you're watching my Instagram or something, you're like, oh, there's Ellie. He's just out there, just traveling the world, just going on to, here he is in Christmas. I'm just trying to make ends meet and, fighting people on Black Friday, trying to find presents for the kids. And here he is taking his whole family to Costa Rica and doing zip lining and going to the beach. And, I think we're going skydiving or something. And then we're doing, snorkeling off some private island. Like we're doing all these things like, oh, it must be nice. Like it's been nice to be rich. Guys, I spent $0 for that. $0 for that. Okay. What I did do was get knowledge and an education and use discipline and put these principles in place. And I just used the system. Okay. I'm going to add to it. In addition to that, and they alluded to this in just the video, I do something called reward harvesting. I just made that up. I search for rewards. And so what I'll do is every year I'll go on and I'll put in best reward, best sign up bonus rewards, right? And what I'll find is, well, I have my American Express. I might go in and they might say, hey, if you sign up with Capital One Spark and you charge $3,000 in the first, 2 months or whatever it is, we'll give you $100,000 bonus points. And they do that because, one, if you're allowed to charge, if you can charge that much, they're probably like, oh, you must be spending a lot. So that's good. They want to give it to you because they think you're going to keep spending. But the same thing, if they get you a big balance, they think you're going to pay it, that interest rate over the next 12 months or whatever. So like the person in the video, when I make purchases, if I have to go buy something, like I just bought 15 refrigerators for a townhome complex that we purchased. And I was like, man, I got to buy 15 refrigerators. Like that's a lot. And so I would search out, like, let me go find a credit card that will give me 100,000 points and, this, that, and that, whatever. I spend a certain amount. And so every year I'll do that. I'll go in there, I'll open a card, usually like 2 cards. I don't get too many. I'll explain to that in a second. But I'll open a card and then I'll charge both those cards. So then I'll get an extra 100,000 points, And I usually do those with cards that have an annual fee, because most of the big reward points, the cards have an annual fee, but you don't generally pay that annual fee the first year. So what I actually do is I sign up in January, and then I'll do the transactions. I'll get my $100,000 points. So I have 100,000 there, 100,000 there. If I can, I'll take those points and I'll transfer them to another card. So I kind of pool all the points together. I'll run those cards for like 8 months, 9 months, 10 months before the annual fee, and then I just cancel them out before the annual fee. And so for that company, I'm their worst nightmare. And they would like to do everything they could do to avoid people like me. And I know I'm on a list somewhere, but I will generally supercharge my benefits every single year. So I might get, for American Express, again, I get that waived. I get all of those reward points that are coming in, right? At the end of the year. But instead, I might have 2 other cards that I get an extra 100, 200,000. We're doing nothing. We're not actually doing is spending, just doing a little bit of extra spending that would normally have gotten me 3,000 points, but I got 100,000 because of the sign up bonus. Do that all day long, and that's how I pay for my trip. So there's actually a whole industry. There's whole websites dedicated to that. I'll let you Google it, or we'll put a link down below, just describing that. It's amazing, but again, it's one of the ways that the richer live better lives because they've done certain things that now they're getting the reward from that. So hopefully that makes sense. If you don't ever do those things, then you'll always look at those people. You're like, I don't understand why they can't do that. That must be so nice. It's not nice. They're not doing anything that you couldn't do. They just did it. Okay. They just foregoed buying a bunch of stuff and paying a bunch of interest on it so that they could have good credit, so they could get the good cards. They just picked a job that they could then go charge on their card so they can get the points at the end of the year. Makes a lot of sense. Like if I can get a $15,000, $20,000 vacation paid for, that's like having another job. That's like, I almost like rather be self-employed, for example, and make $60,000 a year than be employed and make $80,000 a year, because the $60,000 a year is going to let me get the 20,000 anyway and just reward points. It's larger scalar thinking. It's holistic approach to thinking, but that's what we're trying to teach. So we've gotten our credit card, whether it be a first card or a season card. We have, got our first credit card. We've got a credit limit, be $500, $1,000, $10,000. It doesn't really matter. The next thing we need to do is we need to show on-time payments. Okay. And so when I say on-time payments, I'm meaning like payments every single month. However, as I alluded to earlier, I want to see weekly payments being made. Okay. Don't wait until the end of the month and need this big large sum. You're like, oh crap. Don't put things on a credit card that you would normally spend. It's not a case for you to go buy a present. Like if you want to go buy a new purse for $3,000, you don't go buy the new purse unless there's $3,000 in cash in your account. Okay. The only thing you're doing with a credit card is you're just using it instead of your debit card. Okay. You're using it instead of taking physical cash. And so the way that I do that, keep myself in control, is I make payments, and then every Friday I just have a schedule with myself, and I go in and I just I make the payment. I just to pay that off. You can also, as a fail safe, what I would always do is I always set up automatic drafts on my account as well. So just in case, I don't know, for whatever reason, I forgot for 4 weeks to make the payments and I didn't do that, there's an automatic payment that's going to take off the minimum payment. So I'm never late. If you miss a single payment on a credit card, It will be on your credit for years and years and years and years, and it will affect your ability to become worth $100 million. Okay. I want you to really let this sink in. If you miss a payment, it could cost you $100 million nest egg. Okay. Your credit is extremely important. Extremely important. Okay. On-time payments, as remember from the credit history, is a big part of that. Even with a really great credit score, 740, if you had one missed payment like 4 years ago, it can decline you. It can mean higher interest rates. It can mean not doing the deal. Do not sacrifice your $100 million life for a mishap because you wanted a brand new purse and the next new shoes, or you just forgot. You make your payments every single Friday. No question. You can do it every 2 days if you want to. Every single Friday, you make a payment paying off the full balance. And you set the card to automatic draft the minimum payment, just worst case scenario. And you always ensure your account has enough money to pay at least the minimum payment, whatever that is. Okay. In addition, got my credit card. I've set up, I'm making payments, paying the electric bill, paying AT&T mobile phone, whatever, paying my groceries, whatever. I'm making weekly payments. If possible, doing so responsibly, you want to try to max out the limit. Okay. So responsibly, if let's say you had a limit of $1,000, you want to have charged like $980 and then paid it off. All right. So those large purposes, maybe you need to get tires for a car. Maybe you had to get some dental work done. Maybe it's just going out and Christmas shopping, whatever it is. Still following the rule. You do not max out the card, right? Unless you can pay it off, but you got to max it out. Okay. Now, I'm going to caution you. There is a case. I've done this early on. There is a case. Hear me out very, very, very clearly. There is a case that you have $1,000 in your account, like your savings account, the cash. You have $1,000 credit limit, but you only charge $200 or $300 in your account, and you know you need to max out the account, and you don't really have anything to spend it on, right? You could say, okay, this is what I'm going to do. I am going to do, like, this sounds silly, right? I'm going to do grocery shopping for the next month, so I overspend. Like, you have to time it right. You're like, oh, I'm not gonna spend hardly in anything. I'm not gonna do what I'm gonna get down to. I don't have anything. I don't have any gas. I don't have any food in the refrigerator, whatever. Then the new month comes, right? Your credit card balance is zero. So then you're having to spend like extra on food because you've depleted everything, right? And you carry the balance over 1 month. I'm only going to allow you to do it 1 month. So I carry a balance of 500, and then the next month I charge 500. So then I have a balance of 1,000. So I've taken 1,000. That next Friday, you got to pay the card all the way off. Okay. What that means is you're going to pay interest, because the way credit cards work is if I charge something and I pay it off and it doesn't go into the bill next month, I don't pay interest on it. It's like cash, right? And so if I charge and pay it off and charge and pay it off, there's never interest accrued. However, if I charge it in September 1st, October 1st, I'm going to get a bill for that balance. That's when the interest starts. All right. So if I run it, I charge all the way through September, I charge all the way through October, so I can max out that credit card, and then I pay it off like November 1st or whatever. I'm going to pay some interest. For me, it was worth paying the interest that I have, even if it was 25% on that money, because I needed to max out the account. And the reason why I needed to max out the account is because I needed to show the credit card company that I could charge 1,000 and I was butting up against that limit, and then I could pay it off responsibly. So you remember the trade lines, what I showed you is like, if you go to the trade lines, it'll show like credit limit, 1,000, highest credit ever used, whatever, and then the current balance. And so the ideal scenario would be the credit limit is 10,000, the highest credit you ever used, 9,500, balance 0. And so what that's shown to a lender is that you've used a large amount, but then you've paid it down over time. You're responsible. Okay. If you have a $10,000 credit limit, if you only used 1,000 of it, the lender's going to be like, why do you have a $10,000 limit? And when you go apply to another card, they're like, well, you've never really, even though you have a limit of 10,000, you've never really used it. So your credit approval isn't necessarily, and let's say you want to need a $15,000 car, right? Or $15,000 card for whatever reason. Your credit limit isn't your credit limit times 50% or whatever, or like a little bit more. It's your max balance you've ever carried plus a little bit more. So if you have a credit card of 10,000, you've only ever charged 2,000 at any given time. The next credit card you can get approved is probably going to be 5,000 to 10,000, like somewhere in that range. It's just going to be a little bit more. Okay. So you got to max out the credit cards. You get a credit card, you charge it, you make your payments every single week. If you can max out the card and pay it off and max and pay it off and max and pay it off, perfect. No big deal, right? However, if you can't do that, you might want to go a month or so and let the balance run up so you can max it out, but you better be paying it all. Don't run up a big balance and then pay minimum payments. No, that is a ruin to never having money in your life ever, 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 ever. You keep the money in the account just like you when you're paying off each week. You just stop paying off each week. You let the money accrue in your savings account. You let the balance get up, and then you just pay it off. You're paying a little bit of interest, but you're doing that for future benefit. Okay. Once you've done that, you can now then go back. This is why you do it. You can now go back to the bank and you can say to them, listen, I love you guys, Capital One, whatever. Love you guys. It's really great. The way my spending works, and I love to use your guys' card more, but like I don't have enough purchasing power, right? Your credit limit you gave me is $1,000. Like you've probably seen it. Like I maxed out, I've already had to max out my cards. I'm having trouble. Like I'm trying to have to go to other cards. And I'm not really overspending. I'm not really doing anything, or the ordinary. It's just, my bills are more than $1,000 a month. So I'm just running up. So I just don't really use it. I would love to use your guys' card more. Let me ask you a question. Is there any way you could just like increase the limit? Like, I know you just got to do a little bit. Like, is there any way you could just increase the limit to like $2,000? Could you just double it? Just a little bit. Like, could you do anything? Tell me. And so what the credit card company will do is they'll do just that. They'll give you a little bit more because the credit card, remember, they want you to charge a lot on the card because they're getting the interchange fees. They want you to charge a lot on the card because hopefully you'll eventually stop paying the balance and they can charge a lot of interest on more money, right? But they're not just going to give you a big, huge card. They're going to give you like an endless amount, right? And so you have to, but if I go to somebody and I say, hey, my card's $1,000, I'm really just, I'm banging up against the amount. I need more money. I need like $2,000. They're going to be like, why would you need $2,000? The most you've ever spent is 500. You see why hitting that credit limit matters? You got to kind of show them that you need more to get more. Okay. And so get a card, make on-time payments. I would do that for like a good, at least 6 months. Try to max it out, pay it off, max it out, pay it off. Once you have your first card and you've been doing it for about 6 months, I'd go right into my second card. Okay. And so I say, get a card, repeat. And so what I would recommend my children to do is go get yourself a student credit card. It's going to start with $500,000. Take that card, max it out, use it, pay it off, use it, pay it off, use it, pay it off. Don't ever carry a balance unless you're just trying to max it out. Never pay the minimum, like unless you're just trying to max it out the limit for a minute. Always pay it down, never pay interest, get a card with no fees. Once you've done that for 6 months, attempt to go get another card. 6 months is a little early, but just for the sake of speed, 6 months is a good starting point. If you can get 2 cards, you stop using the card A. Let's say card A is $500, right? You get a second card, or let's say card A is $1,000. You get a second card for $1,000. I want you to repeat the process with card A or with card B that you did with card A. So card A, you've gone up and you've charged it. You've maxed out to 1,000. You paid off. Maxed out to 1,000, paid it off. You've done that. Now you've gotten card B. I want you to max that one out and pay it off. Max that one out and pay it off. Now you have 2 cards that have been maxed out, paid off, and you have 2 cards that show on-time payment history. At this point, you're probably a year, 15 months in, right? I want you to repeat that process over and over and over again. Not the getting the card part. Max it out, get an increase, max it out, get an increase, max it out, get an increase, and keep doing that as much as you possibly can. Of course, it's going to be impossible at some point because you might get a balance of like 10,000. You're like, I really don't want to carry a balance of 10,000. It would take me several months to get to that amount. I don't want to pay the interest on it. I get it. Don't do that. You will come across a time in your life where you will need to make a large payment. It could be books. It could be you could purchase a car using a credit card. You could put a down payment on a car using a credit. Like there's a number of different things you'll find. Something might come up. You could have a family member that has money, and you could say, "Hey, Dad, I know you're having to replace the roof. Is there any way that you could actually put 3,000 of that in a credit card, and I can just pay it off so I can max out my credit?" And if they don't understand what you're talking about, show them this video. You can find ways. Be creative. Be friends, but make sure they pay you first. But repeat that process. Ideally, you start with a MasterCard Visa, and you'll probably get a MasterCard Visa to start with. I want you to do that for about a year and a half. Then I need you to go get a Discover. I want you to do that for about 2 years or so, 3 years or so. And then after about year 3 to year 5, somewhere in that range, if you have a credit balance of like say $5,000 and you've been maxing out and you paid it off at least once, you can then go for an American Express, given that you have good income and a good job history. Okay. The idea is you start off with 1, you go to 2, and you want to end up with about 3 to 5 credit cards that you use on a regular basis that you're making on-time payments to that have large balances, anywhere between $10,000 and $40,000, and probably at least one card like an American Express that's unlimited. That might take you from 18 to 28 to do it. But the point is, if doing that process, the idea there is that you're not just waking up at 28 and going, oh, I had a couple of credit cards. I didn't make payments. I was in college. It was $500. I messed up, blah, 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 whatever. You're 28. Now you're trying to go get a house and your credit score is a 650 and you got nothing going on, right? Once you've gotten a couple of credit cards at some point in time within your college, and this could be in early on as well, I need you to go get an auto loan. Okay. If your parents are going to purchase you a car, tell them to please go get an auto loan and do a joint application with you. If you're 16 years old and you have a job, you can go do a joint application with your parents, right? I need you to go get an auto loan. Even if you have money for the car, go get an auto loan. You can get an auto loan for, like I did, for $10,000. Let's say you go buy a car, $10,000. I don't know what car you're buying, whatever. You get financing through the company. You get the discounts and stuff like I talked about earlier. The next day, pay that loan off to not down, make a $9,500 payment to pay that loan off. So you have $500 on the loan. You will pay interest on the $500 at whatever the interest rate is. You're not going to have to make a payment for 5 years because you've already repaid all the payments because you pay the $9,500. You're not paying interest on it. That loan will sit in your credit report and it'll say, okay, even though there's virtually no balance to it. It's an amazing thing. You can go get an auto loan and still pay cash and still get the benefit of an auto loan. So now you're in your mid-20s and I want you to have at least 2 or 3 credit cards. I want those balances to be at least in the $5,000 range, and you need to have an auto loan. At that point in time, I want you to go get an unsecured loan. And an unsecured loan is exactly like a credit card, except for it's not a revolving balance. It's simply a loan. You can get an unsecured loan, and generally they're anywhere from $1,000 to $500, and they could be for various purchases. So, what you could do, similar to an auto loan, you could go get an unsecured loan to take out. You go to the bank, you're like, oh, I need a personal loan. I just want to, I don't know, pay for some things. I want to go on a vacation, right? You could take the $5,000 loan, go into the car dealership, use that $5,000 to actually purchase the car, right? And then just pay the loan back. But you have the unsecured loan in the exact way I just said to you before. But then you have the unsecured loan. The reason why I want you to have an unsecured loan is not just to take out debt and buy something. You got to have something to kind of go purchase, right? You want to have an unsecured loan because it's a different type of debt and it looks good for your credit report for future reference, okay? And for all the people that are out there, the Dave Ramsey types that are like, are you just getting credit? just so you can get more credit. There's no reason to build a credit score if you don't need credit. Just buy cash. Like, great, you're living in a different world. We're talking about living in a world where you're going to sit down with the bank at some point in time and say, I want to borrow $1 million and do a transaction with you. And they're going to look at your credit and they're going to say, what's your credit history? And if they see unsecured loans you've taken out in the past and they've done okay with them, if they've seen credit cards with $10,000, $20,000 balances, if they've seen auto loans taken and paying off. If you're young and you have like a little $5,000, $3,000 unsecured loan, right? And you pay that off, later on down the road, when you have a house and you have to replace the AC, or you have to, like, you're either going to do one or two things, right? Someone comes to you and says, hey, AC's got to be replaced. It's $7,000. You're going to say, I'm going to put this on my card for 7,000, and I'm going to do that because I'm going to get good reward points, or I'm going to be able to max out a card that's going to be good for the future. Or maybe I go down to a local bank and I say, I got to do home improvement. I need unsecured loan because I got to replace the AC. Then you're going to get that. And then you're going to pay that down pretty significantly and then just kind of make small minimum payments for like two years or so. And then you're going to pay it off, right? Either way, you're paying a little bit of interest because those two loans are going to help out your credit score and they're going to show you have a better risk for when you actually need credit. Long story short, you're doing a lot of different things to show yourself you're a good risk so that when you need credit, it's there. Okay. Then you're going to get a mortgage, right? So now you're 18, 19, 20, you got a couple of credit cards, you've been paying those off, max them out, paying them off, max them out, paying them off. Maybe you paid some school tuition that helped you max them out. You got their cards up and they're, $5,000 or whatever credit limits. You went and got yourself an unsecured loan. Maybe you use that to pay for some schooling, some books. I don't know, whatever. It doesn't matter. You pay that off. Now you've graduated. You have a really solid credit score. You have a really good, job because now you're working on whatever. You can go get yourself a mortgage. When you go get that mortgage and they open up, as a person that does looks at underwriting for mortgages, they're going to see nice, solid payment credit history. They're going to see a great credit score. They're going to see a good income because now you've graduated school and you're starting to work or whatever. And they're going to see you had multiple loans, you paid them off. The point though is to make sure you pay those off. Don't go get an unsecured loan and a mortgage and credit cards, and now you have all this debt. The idea is to get it, pay it off, get it, pay it off, get it, pay it off, right? So at the end of it, and you're into your 30s, you're into that period, which is when you're probably going to start to make really bigger moves, to be honest with you. You'll have a credit card, you'll have an auto loan, you'll have unsecured, and you'll have home loan. And you'll have sort of all of those. It starts off with a college-sponsored credit card. Recap, college-sponsored credit card, $500 limit. Pay it, charge it up, pay it off. Ask for an increase, charge it up, pay it off. Do that for 6 to 12 months, get a second card. Do that for another year, get a third card. When you're getting different cards, get American Express Visa, get a Discover. Once you've been doing that for 3 to 5 years, 5 years is better, go get yourself an American Express. Use that. Load your cards so you're putting all the balances into one, all balances in the other. You should be carrying a balance on every single one of your cards every single month if you can. So you can show that as you're making on-time payments. So you might put the electric bill in one card, the T-Mobile bill on a second card, and something else on the third card. You're setting all of those up, paying them off every Friday, and you're setting them all up as a fail-safe to at least make the minimum payment so you never miss a payment. If you do that from 18 to 28, and during that process, you sprinkle in the auto loan, whether you just keep it for a little bit and you pay it mostly down and then you just pay the minimum balance, or at least you just get the loan and then pay it off. And you do that for an unsecured loan, just having those on there as a mix of credit. All it's going to show is you had accounts and you paid it off. You're showing responsibility. So then when you go get mortgages, when you try to go do stuff for fix or flips, when you try to go do stuff to buy a business, when you try to go get an SBA, when you try to go do whatever, you have a credit score that absolutely lenders love. You can wake up in your late 20s, unlike any of your friends in your late 20s, with a solid 750, 800 credit score, because you'll have from 18 to 28, 10 years of credit history with the same accounts being open for 10 years of payment history. Remember the payment history? We had 4.5 years, 5 years. You have 10 years, the same card, paying it. Absolutely, lenders will love it. That is what's going to set you up for leverage. So we're going to stop there. We have covered so far the memory, the mindset. We've covered a little bit about like how you can retire, the formulas to get there. We've covered credit. Now we're going to go into investing. Okay. Now that we know how we have to earn income and what the way we earning income matters, income plus good credit equals leverage. Now that we got leverage and we have the ability to go do some, now I want to go in, I want to talk to you about investing because it's great to have money, but what are we supposed to put it into? Because I need my $100 to be $1,000,000 in 20 years. I need my 1,000 to be 100. Like, how do I move this little bit of money into large sums of money? All of that has to do with investing. We're going to go over some broad investing things, the broad vehicles, and then we're going to talk about the really, really interesting way that you invest. And then we're going to loop in jobs and how investing in jobs matters. And then we're going to loop in how jobs, investing, and investing in taxes, and all of that creates exponential growth in that what the wealthy do is grow massive, massive amounts, and can do so with paying very little taxes because they've chosen all the right ways and doing all the right things. In the exact same way that I travel around the world and using credit card points for doing nothing else than just understanding the formula of charging and doing and just understanding the system and making sure I follow within those guidelines and doing the same things I would do right now to travel around the world, you can pick a job that makes really good income and invest in vehicles that give you a pretty nice return. And the combination of that will allow you to pay taxes lower, as Warren Buffett says, lower than your secretary, lower than anyone else, even though you might be making millions and millions of dollars a year because you're doing exactly what the government wants you to do via the tax code. Until next time, please pay all your cards on time. Don't carry balances. Don't make dumb decisions. Don't let your future self, $100 million self, get robbed by the small little inabilities for you to control your spending. Till next time.